Welcome back, everyone. This week we're going to be covering cannabis and capital returns. Easy lessons that could have saved investors billions. The link to this article will be in the description box below. If you want to go over there, visit, read, and click on the links that are internal of the article. So let's get into this. Today, we're going to quickly cover some core concepts brought to you by capital returns. I'm going to apply it to the cannabis space, a space that is in dire need of basic understanding. And even if you don't care, FYI, about the cannabis space, know that you should still probably read this book. And here's a little spoiler alert. It'd be good that you read the whole book, but really just the first 20 pages and you're good. Yet again, I'd recommend reading the whole thing. It's entertaining, anecdotal, a lot of examples and decision-making processes, but really the first 20 pages, and anytime anyone references this book, they're pretty much talking about the first 20 pages. A simple review of the first 20 pages of this book would have helped prevent so much pain in the cannabis sector. Cup of Coffee Capital is a reader-supported publication. To receive new posts and support my work, consider becoming a free or paid subscriber. Preamble. It's worth knowing that the phrase supply and demand is known as a binomial phrase. It has two nouns, supply, demand, that are connected by conjunction, and. There's a reason that there's two nouns and not just one. That might be your first clue that they both matter. Yet for some reason, supply doesn't get much public discourse. It's as though the word supply gets included only out of habit and not conscious consideration. Supply is treated as though it has no relevance, and at most, it's a second thought. Well, that's the sort of mistake that a person who wants to permanently be permanently removed of their capital makes. Nice little image of how supply is treated versus demand. Some sectors and industries understand the importance of supply better than others. For instance, the offshore oil and gas supply vessel market. An example of the seriousness that they have towards it can be demonstrated from the following screenshot from Tidewater's Q4 2023 conference call. I'm not going to read it to you, but read it for yourself. Actually, no, I will read it to you. That's why they make this a video, So here he says, as we observed over the past few years, the recovery in our industry and our business has been largely driven by the limitations of vessel supply. Demand is certainly more constructive than it was during the depths of the pandemic, but vessel supply has historically been the primary driver of the financial health of our business. As we survey the landscape of future vessel additions, there are multiple factors that provide us confidence in our outlook not only for 2024, but for the intermediate to long term. First, the current order book remains at an all-time low, with a minor number of vessels added during 2023. This is clearly a supportive indicator of limited near-term supply additions. Second, shipyard capacity remains a fraction of what it once was during the recent peak of shipbuilding capacity in the mid-2000s, with many remaining shipyards out of capacity until at least 2026. This is particularly relevant data point as the build time to complete an OSV is estimated to be between 2 years and 3 years. The combination of limited shipyard capacity and the lead time to construct a new vessel provides for a significant runway of time before a material number of new build vessels could deliver and hit the water to alter the supply picture. Notice the attention on supply and capacity. There's a reason for that. Now you might be asking, what does this have to do with the cannabis industry? It's so that this doesn't happen. A national weed glut is causing prices to plummet and imperiling businesses. Link to that article in this article. But this is what happens when people want to focus solely on stuff like this. Global legal cannabis market. Anticipation and projections from 2023 to 2032. While writing this came across my feed. It's yet another example of people not understanding supply and demand. Our president. I am proposing a tax cut to provide $400 a month for the next 2 years for those seeking to buy their first home or trade up for a little more space. Every family deserves a place to call home. Now, I could write an entire article on that, but I'm not going to. So I'll just stop there. This is a great example of what I mean when I speak of the unidimensional focus on demand with minimal, if any, concern towards supply. Demand solutions for supply problems only exacerbates the initial problems and makes it inevitably worse. But I digress. On to lessons from the book. Industrial capital cycle. So this is the industry capital cycle. At the top, you have new entrants attracted by prospects of high returns. Investor optimism. We'll call that 2018. Rising competition causes returns to fall below cost of capital. Share price underperforms. That's pretty much up till now, one could say, but let's call it from 2018 to 2022, we'll call that. Business investment declines, industry consolidations, firms exit, investors pessimistic. I would say that's where we're at. And then improving supply side causes returns to rise above cost of capital. Share prices outperforms. Not so much. We're not really there. I mean, a select few handful of companies perhaps, but in large part the industry as a whole, not quite there. But we're working towards it. Quote, rising competition causes returns to fall below cost of capital. Share price underperforms. What does this look like contextualized to the cannabis industry? Well, here you'll see what that looks like. This is a chart of the returns on capital, which are not that good. You have Verano at 6.4%, Green Thumb at 5.4%, Cresco at 4.6%, True Leaf at 3.2%, and Curaleaf at 1.6%. So that's what this looks like. Rising competition causes returns, that's the return on capital of this chart, to fall below the cost of capital. Now let me ask you this. Do you think that their interest payments on their debt is more or less than the low to mid-single digits that they're getting on their investments? And if it's less, what do you think will happen given enough time? And the answer is what's currently playing out with many companies. The capital cycle anomaly. Asset growth, you can think of that as CapEx, doesn't necessarily equal a good thing. The reason being is that if an industry is experiencing decent growth, more likely than not, that's going to bring about competition. And that competition will compete away the profits and then some. You can see this in this chart. On the y-axis, which is the vertical axis, you have average annual returns, and then the x-axis, the horizontal axis, you can see high asset growth or low asset growth. And it just so happens low asset growth has the highest returns. And that's because less competition competing away the returns. Very simply put, it's multifactorial, it's multifaceted, it's a complex adaptive system. So don't try to, at me with, well, yeah, but, or technically, like, yes. I'm trying to simplify my articles instead of writing 5, 10, 15,000 word articles. This one's 1,000 words, so I'm trying something new, which is just going to open me up for attacks. But I guess that's maybe better than just no one reading a 10,000 word article that's much more accurate and contextualized and true. But whatever. So, what does this look like? this is CapEx as a percentage of revenue. You'll see 2018, 2019, it was upwards of 30, 40, 50, 60%. And then over time, it's dwindled and dwindled and dwindled. And then most recently, this year we'll call it, last quarter or two, they're now mid-single digits. Trulief's at 2%, CapEx is percent of revenue, Verano's 4%, CapEx is percent of revenue, Curaleaf's at 4.3%, Cresco's at 6.6%, and then Green Thumb is at 19.6%. And anybody who's paying attention to earnings calls or looking at, well, the industry kind of already knows this. Many companies in 2023 have radically reduced their CapEx, and Green Thumb has not been doing so nearly as much as its competition. So there's implications to that, but we're not here to discuss those implications. Look at all that CapEx spend. That's supply coming online, and that supply overwhelmed demand. That's what happens in new growth industries with initial high returns on capital deployed. The interesting thing is that people were and still are talking about CapEx spend as a positive. But remember, it's the same as saying, I'm excited for collapsing margins and negative or de minimis returns on capital. And that's a very odd thing to say. Investor overreaction. So on the left, you have the industry capital cycle, which we already covered. And then on the right, you have return on investment. And you can see the investors' expectations overshooting and then correcting and then undershooting and then correcting over time. So you could say that we had the late 2022 dump, and then the end of 2022, the beginning of 2023, you could say is when undershooting happened. You can see that in the basing formation of many of the charts. And then you could say that maybe we've gotten out of that and that we're now adjusting with time, which is the horizontal axis here. So only time will tell if that's happening. Do we double dip? Do we double bottom? Who knows? But that's what happens. People get overexcited because of the high returns, and then they overprice that in, and then reality strikes them, and of course their cognitive dissonance and willful blindness can only last so long, and then that gets overwhelmed, and then they go from one fleeting exaggerative emotion to the next fleeting exaggerative emotion, and then they start dumping, and rightfully so, because things were ridiculously priced, unless you ask a lot of people in the industry, in which things are always too cheap. The stocks are always too cheap. Doesn't matter when, always. Who could have predicted that these companies weren't going to indefinitely grow their revenue to the tune of hundreds of % in perpetuity, or even double digits? I suppose that the answer to that question is anyone with a rudimentary understanding of base rates, base effects, and capital cycles. So here you see total revenues, compound annual growth rate, dropping and dropping and dropping. All the way from, let's say, 2019, they were at 250, 300% total revenue CAGRs, and now we're sitting at, what? Trulief's at negative 7%, Cresco's at 2%, Green Thumb's at 3%, Curaleaf's at 5%, Verano's at 6%. So they went from 2019 growing their revenue at 300%, 250%, 200%, to 2023, beginning of 2024, growing it at mid to single digit %. Mean reversion. A business which sells at a premium does so because it earns a large return upon its capital. This large return attracts competition, and generally speaking, it is not likely to continue indefinitely. Conversely, in the case of a business selling at a large discount because of abnormally low earnings, The absence of new competition, the withdrawal of old competition from the field, and other natural economic forces should tend eventually to improve the situation and restore a normal rate of profit on the investment. TAM Bros. Focus on supply rather than demand. Given that the future is uncertain, why should marathons approach fare any better? The answer is that most investors spend the bulk of their time trying to forecast future demand for the companies they follow. The aviation analyst will try to answer the question, how many long-haul flights will be taken globally in 2020? A global auto strategist will attempt to forecast China's demand for passenger cars 15 years hence. No one knows the answers to these questions. And I highlighted this for emphasis. Long-range demand projections are likely to result in large forecasting errors. What does this look like? This is a chart from 2018, projecting what things would be in 2023. And they estimated that the projected growth of U.S. recreational and medical marijuana sales in the tune of billions of dollars for 2023 would be $21 billion. They undershot 2023 by nearly 50%, or to the tune of $10 billion. And here we go again. I guess we'll find out its accuracy in a few more years. So this chart, most recently updated July of 2023, and they're calling for, I want to say, I could be mistaken here, and then another problem is, a chart I showed you earlier, they say the cannabis industry, well, does that count CBD, does that count hemp, blah, 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 are they factoring that in? The answer is, some charts are, some aren't. Notice how this said recreational and medical marijuana, so I would say that's not counting hemp. But then you see other projections that say cannabis. This is the problem with how people want to bastardize and corrupt their language. Because marijuana is cannabis, but cannabis isn't just marijuana. But if you want to use the words interchangeably as though words don't have definitions and instead they're just placeholders for sentiment, then, well, you're probably too far gone and corrupted that you've now compromised the orientating mechanism known as your speech to the extent that you won't be able to pull yourself out of the hole that you've dug. And, well, good luck and God bless if that's the case. And in all probability, that is the case because on a balance of probabilities, that's most people I just described. So, they undershot it by $10 billion. So, simply put, the scope of possible outcomes is vast. In 2018, people undershot the size of the future market yet overshot the growth of the companies, which means they underestimated the supply and demand, which disproportionately affected the companies' stocks. The revenue that these companies have grown has been more the consequence of volume than price. Base rates. Remember earlier when I said, quote, who could have predicted that these companies weren't going to indefinitely grow their revenue to the tunes of hundreds of percent in perpetuity or even double digits? I suppose that the answer to that question is anyone with a rudimentary understanding of base rates and base effects, end quote. Well, capital returns also talked about base rates. However, it's being referred to as the outside view. By the way, Michael Mauboussin has extensively talked about this concept, and I recommend that you just read and listen to as much of his work as you can get a hold of. You can't go wrong there. So, well, capital returns also talked about base rates, but they referred it as the outside view. In the inside view, oh my gosh, I think this clipped off a section of the screenshot I took. Extrapolation. The inside view is linked with our tendency to extrapolate. Behavioral finance, a branch of economics established by Kahneman and his late colleague Tversky, describes how we anchor on the information placed in front of us and are overly influenced by our immediate experiences. Recency bias. Another common heuristic is the tendency to draw strong inferences from small samples. These weak weaknesses reinforce the propensity of investors to make linear forecasts, despite the fact that most economic activity is cyclical. There are trade cycles, credit cycles, liquidity cycles, real estate cycles, profit cycles, commodity cycles, venture capital cycles, as anybody who's been observing things over the last year or two know about, and of course, industry capital cycles. Our inclination to extrapolate must be hardwired. All right, on to game theory. Prisoner's dilemma. Game theory can also explain overinvestment within an industry. Managers in any business with high current profitability may face a problem akin to the prisoner's dilemma. Take a situation where future demand growth can profitably accommodate expansion by a single player, but no more. If several players simultaneously expand their operations, their aggregate profits will decline at some future date. Under such circumstances, it's collectively rational for the incumbents to prevent any expansion, since gains only accrue to one of their number. If the industry is competitive or has low barriers to entry, there is an incentive for one player to break ranks and enjoy the fruit of expansion. Or, in the cannabis industry, practically all of them to break ranks. The remainder may feel obliged to follow suit, as they can't abide a competitor leaving them standing and may wish to protect market share. Thus, excessive asset growth can result from a lack of cooperative behavior within an industry. Now, I didn't put a link here, but I have an article and a video, I believe, about the cannabis industry game theory, in which I talk about that right there. And I presented you this below image I'm getting ready to show you again. I've presented this below image to you numerous times. Let's see if we can, here we go. Now this is in regards to tankers, product tankers, but it holds just as true here in many other industries as well. Now I'm not going to say it because this chart has some cuss words in it, but it holds true. The tenets of capital cycle analysis. The essence of capital cycle analysis can thus be reduced to the following key tenets. Most investors devote more time to thinking about demand than supply, yet demand is more difficult to forecast than supply. I highlighted this one, changes in supply drive industry profitability. Stock prices often fail to anticipate shifts in the supply side, and boy did they. Just go look at stock prices from 2018 till now, and much of that can be explained as a consequence of supply and the prisoner's dilemma that we just talked about. The value growth dichotomy is false. Companies and industries with a supportive supply side can justify high valuations. Management's capital allocation skills are paramount. A lot of C-suites dropped the ball on that one, didn't they? And meetings with management often provide valuable insights. Now, most of us can't do that, so listen to a conference call, people. It's okay, you can do it. Or read one. Investment bankers drive the capital cycle, largely to the detriment of investors. When policymakers interfere with the capital cycle, the market clearing process may be arrested. New technology can also disrupt the normal operation of the capital cycle. Generalists, that's me, generalists are better able to adopt the outside view necessary for capital cycle analysis. By the time you watch this video, if you want to know what the outside view is, I'm going to go back to this article and figure out what went wrong and why it didn't screenshot or transfer over to this, because that was actually kind of important. And I failed you by not proofreading this again. So generalists are better able to adopt the outside view necessary for capital cycle analysis. Long-term investors are better suited to apply the capital cycle approach. So that's worth thinking about, because a lot of people in this cannabis space are not generalists. They seemingly are solely focused on this. Even though they might have come from another discipline, they seemingly dropped much of what they do, and I wouldn't call most of them generalists. I'm a macro tourist kind of person, or a generalist, and I just bounce around. Notice I didn't own any cannabis stocks until Cup of Coffee Capital came around, inception date January 1st, 2023, and I didn't buy the first one until later than I wanted to, but I've already talked about that, but until January or February of this year. So I missed, even before Cup of Coffee Capital came around, I missed all of that. I've written numerous articles on this topic, so I won't belabor the points I've already belabored. So, pot stock shareholders underestimated the shift on the supply side, as well as the subsequent price declines, aka price normalization. M&A, it's not what you think. And to think that all you had to do was read the first 20 pages of this book to not get wrecked in the cannabis industry over the last half decade. I'll throw in one more because it's a nice parallel, and we're just going to skip all this and go to the highlight section. In part, Heineken's underperformance was due to a series of poor and overpriced acquisitions. Poor and overpriced acquisitions. Wonder where we've heard that before. Here are but a few examples. Aurora Cannabis acquired MedRelief for $3.2 billion in 2018. Aurora Cannabis acquired Cannamed for $1.23 billion in 2018. Canopy Growth originally acquired Acreage Holdings for $3.4 billion. Constellation Brands invested more than $4 billion in Canopy Growth. By the way, the impairments they've had on that since then are to the tune of billions of dollars. Altria invested $1.8 billion in Cronos, which is interesting because now Cronos, as of last week, was considered a net. If you're a value investor, you know what that is. If you're not, go Google it. So up until last week, it was a net, and it was trading below its net current asset value with a market cap. Cronos had a market cap, or does, of, roughly, call it $800 million. So the market cap is $800 million. I know that's not the enterprise value, blah, 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 but the market cap's actually trading below the enterprise value. Anyway, the point is they bought something for $1.8 billion, or invested $1.8 billion in something. It's not like they owned the whole thing. $1.8 billion, and now it has a market cap of, we'll call it just half of that. So less than half of that. So that's interesting. The Constellation Brands thing, they've taken multiple impairments on that, hundreds of billions at a time. And I think 1.1 billion was the most recent one they took. So, horrible. It's no surprise that consolidation can provide better pricing power. But let me ask you this. If consolidation means pricing power, what does not being consolidated mean? Consolidation equals pricing power. Non-consolidated equals non-pricing power. For the last half decade, people have been saying what makes this industry so exciting is that there are a lot of new participants rapidly growing. But as I have outlined to you above, that's the same as saying this is a heavily fragmented market with little pricing power and even less profits. So let me ask you this, would you invest in something? I give you a sales pitch and I say, hey man, this is a heavily fragmented market that's new to everything it's practically doing, and it has very little pricing power and even less profits. Do you want to invest? Your answer would probably be no. So if you replace the word cannabis with practically any other word or phrase, people wouldn't have been interested in investing in this sector, but they turn a blind eye to the natural unraveling and development of the industry due to their affinity for the product and its associated ideas. And that has been a costly belief to many. In conclusion, so there you have it. Spending $50 and a couple of hours of time reading would have saved the industry participants a collective fortune. Canadians have lost more than $131 billion investing in cannabis companies. Link in the description. I don't know if that's Canadian dollars or American dollars, and it really should say Canadian investors, not Canadian, but anyway. But to each their own, I suppose. I still get ample pushback on these basic market dynamic concepts. Demand-side-led growth stories without consideration to the supply side is the evergreen false idol of fools. Demand side to the rescue. But I guess with comments like the ones below, maybe I'm wrong for even recommending this book. Here's the comment. If you think the market gives two shits about return on capital as a meaningful thesis for pot stocks at this stage, there isn't anything I can say that will convince you otherwise. Well, I'll let you, the listener, decide what to make out of that. Oh, and in case you're wondering where I think we are with things, I'd currently say somewhere in here. Notice the highlighted section between business investment declines, industry consolidations, firms exit, investors pessimistic, and rotating to improving supply side causes returns to rise above costs of capital, share price outperforms. But be forewarned, with federal legalization, uplisting, and interstate commerce, we could see a redux of the period where everyone lost their minds, capital poured in, and returns on capital vanished. And if the American politicians don't enforce some sort of countervailing measure in the form of anti-dumping laws, Canadian companies are going to put the hurt on American companies. But that's a whole different conversation. Cup of Coffee Capital is a reader-supported publication. To receive new posts and support my work, consider becoming a free or paid subscriber. Thank you for watching. Until next time.